Here is the question every new investor eventually asks. Not what should I invest in, but how do I put it all together? Because most people understand by now that index funds work. They understand that compound interest is powerful. They know they should be investing. But when they sit down to actually do it, they freeze. How much goes in stocks? How much in bonds? Should I hold cash? What about property? What about gold? Am I taking too much risk? Not enough. These questions stop more people from investing than any lack of money ever does. Today, that changes. By the end of this video, I am giving you the exact blueprint for building your first investment portfolio. No jargon, no complexity, just a clear, simple system that works at any income level at any age. Stay with me, because the mistake in Section 5 is the one that costs most first-time investors the most money. Welcome to Money Explained in Minutes. By the end of today, you will know exactly what goes in a portfolio, how much of each, and exactly how to build one this week. Let us get into it. Let us start with the most basic question. What is an investment portfolio? Most people imagine something complicated, a spreadsheet full of stocks, a Wall Street trading desk, something for experts. Here is the reality. A portfolio is simply the collection of all your investments. That is it. If you have a pension, that is part of your portfolio. If you have an ISA or a Roth IRA with an index fund, that is part of your portfolio. If you have cash savings, some people count that too. Your portfolio is the complete picture of where your money is working or where it is not working. Now, here is why building a portfolio deliberately matters. Most people do not build a portfolio. They accumulate one by accident. They open a pension at work and forget about it. They buy a few shares of a company they heard about. They leave most of their money in a savings account. The result is a random collection of financial products with no strategy, no balance, and no clear direction. A deliberately built portfolio is the opposite of that. It is a set of investments chosen specifically to work together, to grow your wealth at the right rate for your risk level, and to protect you when markets get difficult. Every investment portfolio, regardless of size, age, or risk level, is built from three core building blocks: equities, bonds, cash. That is it. Those are the ingredients. Everything else, property, gold, commodities, crypto, are additions to this foundation. Not the foundation itself. Let us look at each one. Building block 1. Equities. These are shares in companies. When you buy an index fund, you are buying equities. Equities are the engine of long-term growth in any portfolio. Over the long term, they deliver the highest returns, but they also carry the most short-term volatility. Your portfolio can fall 20% in a bad year, and it can rise 30% in a good one. Equities are for growth. They reward patience. Building block 2. Bonds. A bond is a loan you make to a government or a company. They pay you a fixed rate of interest in return. Bonds are more stable than equities. They do not grow as fast, but they do not fall as hard. When stock markets crash, bond prices often rise because investors move their money to safety. Bonds are the stabilizer in a portfolio. They smooth out the ride. Building block 3. Cash. Cash in a portfolio is not the same as your emergency fund. It is a short-term buffer, money you might need in 1 to 3 years. That should not be exposed to market risk. Cash does not grow much, but it does not fall either. In a portfolio, cash is the shock absorber. The three building blocks work together. Equities grow the portfolio over the long term. Bonds stabilize it when markets get rough. Cash protects what you need in the short term. So now you know the three ingredients. The next question is, how much of each? And this is where most people overcomplicate things. The answer is actually very simple. It comes down to one thing: your time horizon. How long before you need this money? If you need it in 5 years, you need to be cautious. If you need it in 30 years, you can afford to be aggressive. Here is why time horizon matters more than almost anything else. Over any 1 year period, the stock market can fall dramatically. In 2008, the S&P 500 fell 48% in a single year. If you needed that money in 2009, you lost nearly half. But over any 20-year period in modern history, the stock market has always been positive, always. So the longer your time horizon, the more you can hold in equities. The shorter your time horizon, the more you need in bonds and cash. Here is the classic rule most financial planners use. Take your age, subtract it from 110. That is roughly how much of your portfolio should be in equities. At age 30, 80% equities, 20% bonds, and cash. At age 50, 60% equities, 40% bonds and cash. At age 70, 40% equities, 60% bonds and cash. This is not a perfect formula. No formula is. But it gives you a starting point that most professional advisors would not disagree with, and you can adjust it based on how you feel about risk. If a 20% drop in your portfolio would cause you to panic sell, you need more bonds, less equities. If a 20% drop does not worry you because you are in it for 30 years, you can hold more equities and let time do the work. Now let us talk about something that sounds technical but is actually one of the most important free protections available to any investor. It is called diversification, and it is the closest thing to a free lunch in investing. Here is what diversification actually means. Do not put all your eggs in one basket. You have heard that before, but let us make it precise. If you put all your money into one company and that company has a bad year, your entire portfolio has a bad year. If that company goes bankrupt, you lose everything. We have all seen it happen. Enron, Lehman Brothers, Kodak, Blockbuster. Every one of those was once considered unbeatable. Every one of them destroyed the savings of people who had concentrated too much in a single company. Diversification protects you from this. When you own 500 companies through an index fund, the failure of one company barely affects your portfolio. It is absorbed by the performance of the other 499. But diversification goes further than just owning many companies. True diversification also means spreading across different asset classes. Equities and bonds do not always move in the same direction. When equities fall, bonds often rise. A portfolio that holds both is smoother than one that holds only stocks, and spreading across geographies adds another layer of protection. US stocks and international stocks do not always move together. A global index fund gives you this automatically. This is why the simple portfolio, index fund plus bonds, works so well. It is diversified across companies, asset classes, and geographies, all in 2 or 3 funds. Here is section 5, the one I told you to stay for. The biggest mistakes first-time investors make when building a portfolio, and understanding them will save you from losing money that you never had to lose. Mistake 1. Waiting until you have enough. There is no enough. Every month you wait is compounding. You are not collecting. Someone who waits 5 years before starting their portfolio does not just miss 5 years of growth. They miss those 5 years compounding for the next 30 years after that. The cost of waiting is not linear. It is exponential. Start with what you have, even if it is small. Mistake 2. Picking individual stocks instead of index funds. We covered this in detail in the last video. 90% of professionals cannot beat the index over 10 years. You are not more likely to beat them. Stock picking feels exciting. Index funds feel boring. Boring wins. Mistake 3. Checking your portfolio every day. This is one of the most psychologically damaging things a new investor can do. The more frequently you check, the more short-term noise you see. And short-term noise looks like disaster. A portfolio that falls 2% in a week looks fine over a year. But if you check it every day, it feels like a crisis. Check your portfolio once a month at most. Set it up. Automate the contributions. Walk away. Mistake 4. selling when markets fall. We have covered this before, but it bears repeating because it is the single most costly mistake investors make. Markets fall, always have, always will. The question is never whether markets will recover. The question is whether you will still be invested when they do. Selling turns a temporary loss into a permanent one. The people who stayed invested through every crash in history recovered and grew beyond the crash. The people who sold locked in their losses and missed the recovery. Mistake 5. Building the perfect portfolio instead of any portfolio. Perfection is the enemy of progress here. The perfect portfolio built in 6 months is worth far less than a good portfolio built today, because the good portfolio started compounding today. The perfect portfolio started compounding in 6 months. Start with a simple 2-fund portfolio. 1 broad market index fund, 1 bond fund. That is enough to begin. You can optimize later. The most important investment decision you will ever make is not which fund to pick. It is deciding to start. Here is your 5-step portfolio building action plan. This week, 0 cost. Works at any income level in any country. Step 1. Decide your time horizon. When do you actually need this money? Retirement, 20 or 30 years away, or a house deposit in 5 years. Your time horizon determines your allocation. Write it down right now, the number of years you have. Step 2. Choose your allocation using the 110 minus age rule. Take 110. Subtract your age. That is your equity percentage. The rest goes in bonds and a small amount of cash. If you are 25, 85% equities, 15% bonds. If you are 45 to 65% equities, 35% bonds. Step 3. Choose your funds. 1 broad market index fund, global or S&P 500. 1 bond index fund from Vanguard, Fidelity, or BlackRock. That is your entire portfolio. 2 funds. Step 4. Automate contributions. Set up a direct debit or automatic transfer on payday before you can see it, before you can spend it, even $20 or $50 to start. The automation is more important than the amount. Step 5. Review once a year. Rebalance if needed. Once a year, check if your allocation has drifted. If equities have grown to 90% and you wanted 80, sell a little of the equity fund and buy more of the bond fund. This is called rebalancing. It takes 20 minutes once a year and it keeps your portfolio aligned with your risk level. Let us bring everything together. A portfolio is simply the collection of all your investments. The 3 building blocks are equities, bonds, and cash. Equities grow, bonds stabilize, cash protects short-term needs. Your allocation should reflect your time horizon. The longer you have, the more equities. The shorter, the more bonds. Use the 110 minus age rule as your starting point. Diversification across companies, asset classes, and geographies protects you from concentration risk for free. The 5 biggest mistakes are waiting, stock picking, checking daily, selling during falls, and chasing perfection instead of starting. Your action plan. Decide your time horizon. Apply the 110 minus age rule. Choose 1 index fund and 1 bond fund. Automate contributions on payday. Review and rebalance once a year. That is a complete investment portfolio, not complicated, not expensive, not reserved for experts. Available to anyone, starting this week. The moment this video ends, write down 1 number. How many years until you need this money? That number unlocks your entire strategy. If this gave you value, subscribe to Money Explained in Minutes. Every week, 1 important money concept made as simple as possible. No jargon, no lectures, just clarity. Drop a comment below. What is your biggest question about building a portfolio? I read every single one. Subscribe so you do not miss next week. Money Explained in Minutes. Understand money. Build wealth. See you next week.